Let us begin with our first financial statement. The first of three financial statements is the statement of financial position, or balance sheet. The statement of financial position, or balance sheet, lists the assets, liabilities, and capital of a business or organization at a point in time, typically a month, a quarter, or a year. We will define the elements of the balance sheet in our program. Why do assets equal liabilities and capital? Assets cannot be greater than liabilities and capital, because if they were, it would mean unclaimed assets. There is no such thing. Every asset has an owner. Liabilities and capital cannot be greater than assets, because capital, by definition, is a residual claim. It cannot be more than the assets less the claims of creditors, liabilities. An asset is a resource that is owned or controlled by an entity that will provide probable future benefit. In short, an asset is an item of economic value. A liability is a value that an entity is expected to deliver in the future to satisfy a present obligation arising from past events. In short, liabilities are the claims of creditors. Capital or equity is the claim of owners. Capital or equity is a residual claim. Assets minus liabilities equals equity or net. Let us look at home ownership as a way of identifying assets, liabilities, and capital. We buy a home for $300,000, the asset. We borrow 80%, or $240,000, with a mortgage, the claim of creditors. Our down payment of $60,000 is equity, the claim of the owner. Notice that assets do, in fact, equal liabilities. House sells for $330,000. Mortgage of $240,000 is paid, and proceeds to the seller are $90,000, a residual value. Here, upon the sale, a $30,000 profit raises the proceeds. If the house went down in value and was sold for $275,000, the liabilities would still be $240,000, and the payout to the owner who sold the house would be $35,000. Here again, capital is a residual claim. The claim of the owner is the asset at $275,000 minus the liability of $240,000, leaving $35,000 to the seller. Once again, capital is a residual claim. It is whatever is left after satisfying the claims of creditors. Assets equal liabilities and capital. Assets equal the claim on assets, namely liabilities and equity. Assets minus liabilities equals net assets, or capital. Once again, capital is a residual claim on assets. Let us break assets down into three categories. Current assets are assets that are cash and equivalents, or will be converted to cash or consumed by the business during the coming 12 months or the next full accounting cycle. Fixed assets have physical properties and useful lives of greater than 1 year. Intangible assets will have no physical properties and useful lives of greater than 1 year. Cash is the universal medium of exchange. Cash equivalents are assets readily convertible to cash, such as treasury bills, short-term investments, and money market funds. Accounts receivable are amounts due from customers who have purchased products or services. They're normally due within 30 days of the transaction, sometimes within 10. Inventory includes items held for sale to a customer. Deposits are amounts paid for a future service, such as rent deposits, contract deposits, or security deposits. Prepaid expenses are not expenses, they are a current asset. They are amounts paid in advance for services to be rendered in the near future. Examples include prepaid advertising, prepaid legal services, and prepaid rent. All of the above are cash and equivalents, or items that will be converted to cash or consumed by the business within 1 year or the end of an accounting cycle. Equipment includes assets with physical properties that have useful lives greater than 1 year. Examples: vehicles, computers, manufacturing equipment, X-ray machines. Accumulated depreciation is what we call a valuation account or contra account. We say it is the fate of most assets to become expenses. What do we mean by that? In the case of equipment, we allocate its cost ratably over its useful life by depreciating it. We have a whole chapter devoted to depreciation. Here, suffice it to say, a portion of an asset's cost is allocated to depreciation expense each year and increases the valuation account, accumulated depreciation. An increase in accumulated depreciation means a decrease in net equipment. Additional examples of fixed assets include leasehold improvements, amortization, land, and building accumulated depreciation. Intangible assets have multi-year value, but no physical properties. They include copyrights, the exclusive right given to an originator or an assignee to print, publish, perform, film, or record literary, artistic, or musical material. Examples include a book, a movie script, a song, a training manual. A patent, a government authority or license conferring a right or title for a set period, especially the sole right to exclude others from making, using, or selling an invention. Examples: a drug maker with a patent on a new drug, a proprietary process, or a new design. A trademark, a symbol, word, or words, registered or established by use as representing a company or product. Examples: McDonald's Golden Arches, Mercedes-Benz's three-pointed star, Nike's swoosh, and Apple's apple. Goodwill in accounting has a very specific meaning. When one company acquires another, goodwill is the amount paid above and beyond the book value of the acquired company. The book value is the amount recorded on the books of the acquired company as stockholders' equity. Example: Company A acquires Company B for $5 million. The financial statements of Company B show stockholders' equity as $3 million. In this case, goodwill is $2 million on the books of the acquiring company, Company A. In this course, we will learn why one company would pay more than the book value of an acquired company. Liabilities are obligations of a company that result in the company's future sacrifices of economic benefits to other entities or businesses. Put simply, liabilities are the claims of creditors on the assets of an entity or business. Current liabilities are obligations due within 1 year or the end of an accounting cycle. They include accounts payable, short-term debt obligations owed to vendors who've supplied inventory or rendered services. Accrued expenses are not expenses. They are short-term obligations arising from expenses incurred, but not yet paid. For example, a phone bill or utility bill for March, received in April. At the end of March, both were expenses, even though they were paid later. Unearned revenue is not revenue. It is a short-term debt obligation arising from amounts paid to a company for goods or services not yet delivered. For example, a contractor deposit for a remodel job not yet performed, or a retainer paid to an attorney for services not yet delivered. Taxes payable are amounts due to a government entity on earnings realized. This includes income tax, property tax, and payroll taxes withheld. Short-term notes payable are borrowings secured by a note due within a year. Current portion of long-term debt is the amount due this year on mortgage debt. For example, a monthly mortgage of $3,000 or $36,000 for the year on a $600,000 mortgage. If interest is $24,000 and principal repaid is $12,000, then $12,000 is the current portion of long-term debt. Consider this ratio: current assets divided by current liabilities. Let's assume current assets are $100,000 and current liabilities are $125,000. By calculating that simple ratio, called the current ratio, we learn that the company is headed for a cash crunch. It doesn't have enough current assets to pay its current liabilities. A safe ratio is $2 of current assets for every $1 of current liabilities, a 2-to-1 ratio. By calculating this simple ratio, we are able to determine the company's short-term liquidity. Long-term liabilities are debt obligations that are due beyond 1 year, or the end of the accounting cycle. Notes payable is debt secured by a note, with payment terms for principal and interest. Example, a company buys equipment costing $20,000. It pays $5,000 and borrows $15,000, so that's it with a note payable. A mortgage payable is long-term debt secured by real property, meaning real estate, loans from stockholders, and is exactly that, a loan from a shareholder. Bonds payable is a long-term debt obligation resulting from borrowing from the investor public. A publicly traded company can sell bonds to raise money. A bond is usually sold for $1,000 with a stated interest rate and maturity. Maturities can run from 1 year to 30 years. Long-term reserve for warranties is a liability arising from a long-term guarantee. Example, a car manufacturer offers a 3-year warranty on the sale of its cars. Part of those warranty costs will be incurred each year. One thing to note, the warranty costs are an estimate. Equity, or capital, is the claim of the owners of the business. The accounts are different for sole proprietorships, partnerships, and publicly traded companies. For sole proprietors and partnerships, the total claim results from contributed capital, income or loss from the business, and draws from owners. Contributed capital increases the total capital account. Profit increases the account. Loss decreases the account. Draws reduce the capital or equity account. The equity accounts for a privately held corporation include contributed capital, a claim representing amounts contributed to the business by owners. Income gets closed out to retained earnings. Loss decreases retained earnings. Distributions are identified as dividends and reduce retained earnings. Speaking of retained earnings, it is defined as a capital claim on assets earned and retained by the business. It is not money. It is a capital claim. It is not specifically a claim on cash. It is a claim on all assets earned and retained by the business. The business can earn a profit and invest in more inventory, accounts receivable, or equipment. Example, a business has a profit of $100,000 and pays dividends of $30,000. The retained earnings would be $70,000. However, that remaining profit might not all be cash. It could be invested in other operating assets. In a publicly traded company, the accounts are common stock, preferred stock, treasury stock, dividends, and retained earnings. Common stock is the par value of one share times the number of shares outstanding. Par value. What is that? It is an arbitrary value. It can be $1, $5, $10, or more. If the actual price paid by investors is more than the par value, the additional amount is credited to additional paid-in capital. Preferred stock is stock that has a higher priority of claims than common stock and typically has a fixed dividend. Treasury stock is an amount a company pays for some of its own shares. Why would a company buy its own shares? If a company has profits but cannot effectively reinvest its profits, it might buy back some of its own shares. The idea is fewer outstanding shares for a certain profit means more profits per share. Dividends are amounts paid out to shareholders, a debit to dividends and a credit to cash. The debit to dividends is a reduction in total capital because capital has normal credit balances. The debit to dividends reduces retained earnings. Retained earnings is the owner's, shareholders' claim on assets earned and retained in the business. Once again, retained earnings is not money. It is an owner's claim on assets earned and retained by the business. Here, common stock has a par value of $5. That par value is totally arbitrary. It could be $1 or $5. What counts is what an investor pays for the stock. In our example, 10,000 shares are sold for $7 each, or $70,000 total. $5 times 10,000 and is $50,000 attributable to the common stock account. The remaining $2 times 10,000 shares is $20,000 and is credited to additional paid-in capital. The total contributed capital is 50,000 common stock plus 20,000 additional paid-in capital for a total of 70,000.